Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how's it going? It's Phil Tarrant here. I'm the host of the Smart Property Investment Show. Sometimes host. I've got a growing team here, and you'll start hearing from other people coming to the podcast. I introduced Liam Garman, Managing Editor for Real Estate, the other day. If you tuned into it, we had a really good chat. He's someone I've worked with quite a lot over the years and do stuff with him. He's quite political, so we had a really good discussion around what's happening and what the election is going to look like and how housing policy is going to be determining a lot of the outcomes. We're recording today, waiting to see what will happen with the election that's happening in the US. Votes have just started to come in, so I'm obviously timestamping when this discussion took place, and there will be discussions and ramifications from that about what does it mean for the economy here in Australia when you've got a change in president in the US, and specifically how that may shape and influence housing markets and access to housing and housing as a vehicle of investment. So stay tuned for those discussions. We'll have them. But today is one of those times, I could do a couple of times a month, where I get together with Eva Loisance from Finni Mortgages to chat through all things mortgages, keeping our finger on the pulse of mortgages, what's going on in mortgages, how you can ensure your best position from a finance point of view to continue your investment journey or recalibrate it or expand it or whatever you want to try and achieve. We talk technical, and we talk products, we talk strategy, we talk everything to do with finance, because we all know that real estate investment, property investment is a game of finance. I don't know many people that do it without it. There is a lot of cash buyers out there, but most people tuning into this podcast are leveraging into property using the money they're able to create, whether it's through drawing down equity in current properties or savings to extend their property investment journey. Eva, how you going?
Great, thank you. Very excited to chat about this today. I think it's there's a lot there we need to cover.
Yeah, I thought the sort of discussions I've been having with people recently is like, you know, most of the sort of refinance stuff is washed through by now because, you know, interest rates gone up. People have come off fixed rate mortgages on the variable rate mortgages. So if you were going to refinance, most people would have refinanced by now. Is there any weight to that, or is there still a lot of people out there still refinancing?
I think that's right in the sense of owner-occupier who don't have much than just their house and chasing the cheapest rate that there is. We've seen lately fixed rate being quite low and people refinancing to new lower fixed rate, which we don't really push for, because obviously if the rates are getting low on fixed, it's because it's on the way down. But that's one thing, and that's what I want to talk about today. Is there's so many more reasons why people would refinance, and rate is just a tiny bit of a portion of it.
Yeah, okay.
Especially for investors.
So I'll take your point that a lot of people, if they've got one owner-occupied loan, they may have, if they haven't looked at their mortgage yet, I'm sure you guys will be happy to do it, but for an owner-occupied type mortgage. But what we're talking about is investors transacting in property, buying properties, growing properties, renovating properties, looking to buy the next property. So they will functionally be refinancing because most of them will be drawing equity potentially from their current portfolios in order to drive that. I've got a nice big headline for this, the 10 hidden benefits of refinancing. That's pretty good.
Yes.
I can see it. That's a bit of clickbait there for all of you people, particularly property investment. They little headlines like that really grab people's attention.
As well, if people haven't looked at their mortgage in the last 6 months, for sure they're paying too much.
Really?
Yeah.
No.
Yeah.
That's a big, bold claim.
Yeah, no, it's obvious. Banks aren't repricing clients unless they're asking, and often unless they are proving they can get better somewhere else. And people don't know how to do that.
Yeah, yeah. I actually had a chat with someone on the podcast semi-recently, and they didn't use Finni, and I said to him, "What are you doing? You're a madman. You should be using Finni Mortgages." But he used another very good mortgage broker, so at least he's using broker. And he tried to get his loans repriced. I can't remember which lender he was with. He was with one specific lender, and he's like, "I need a sharper rate. You're overcharging me here, and here's all the reasons why. Here's the comparables. Gave them all the evidence." And they're like, nah, because there was a serviceability type of thing. He was refinancing, I don't know, 6 or 7 loans. I can't remember exactly the number. So he went, stuff it, I'm going to refinance a lot with another bank.
And then they came to the party.
and then they come to the party. So when they got the discharge documentation, so he had to go through the whole process with another broker to actually set it with a new bank. And I think he pushed it to one or two different banks, so he's expanded out. Only then did the bank say, oh, no, let's have a discussion about it, let's talk about it. And he went, that ship has sailed. I'm sorry, you've missed your boat. You thought I was saber rattling and just bluffing. No, this should have been sharper. You should have done it. So for those bank executives out there tuning into this or working in the bank, like, it may be a strategy to make it hard to reprice a loan, but eventually smart consumers will vote with their feet. So it's a risk they've got to take. They probably lost maybe $5-6 million in borrowing from it, that off their loan book went to another bank purely because they wouldn't sharpen up their rate a little bit. So, so he had to refinance in order to get the rate. And I still go through the process every now and then. I've sort of given up recently of calling up all the banks saying, can I have a sharper rate? They normally get stuff. And my stuff's pretty tight already. Like, I think my rates aren't too bad. I think you know them. And we're recording this the day after the November rate announcement, and rates obviously are on hold. My view, I can't, and I've been saying this for a while now, I can't see us getting a rate cut until the second half of next year, and maybe later in the second half of next year. There's people holding their breath for a February rate cut. That's not going to happen, and I don't think there'll be a rate cut before the federal election. So watch this space. So that may mean the election may be pulled earlier. That's for political people.
Aside from that, there are banks right now and lenders dropping their rate outside of what the RBA is doing.
Yeah, and you need to find that out, right? So give them a call and try it yourself.
Whatever the RBA is doing, I mean, it's obviously a big thing. The banks are acting.
Well, fixed rates are coming a lot sharper. I was speaking to someone the other day and they were getting sort of 0.9 off the standard variable rate fixing. So the banks are telegraphing it at some point. It's going to start coming down. But don't expect rates cuts to happen at any point soon. And I would preface that also, if there is cuts to the official cash rate, do not expect the banks to pass it on. You're going to have to fight for it.
Yeah.
So my point would be, get ready, get set, so you can go at a point in time if rates start coming down. If your bank does not come to the party, be ready to refinance. So it means you need to get your stuff ready. So anyway, more competitive rates or products are just one of the reasons why you may refinance. You've got 10 hidden other benefits of refinancing. Great headline. Welcome back, Phil Tarrant from Smart Point Investment, chatting with Eva at Finni Mortgages, finni.com.au, the broking firm that we go to for analysis and interpretation in and around mortgages and mortgage broking. Finni does all my mortgages. They did a huge refinance for me recently and a whole bunch of new debt. And I like these guys so much, I actually invested in the company. They do such a good job. So Eva's their head broker. We have a chat a couple of times a month of what's going on. Today we're talking about the hidden benefits of refinancing. Number one, Eva, debt consolidation.
Yes.
Tell me about it.
So that could be for anyone that's mum and dad just with their home. And let's say they're trying to get a better rate and their bank is just saying, look, it's not working. They go somewhere else. They're not servicing. They're just stuck. And often it's because they've got a credit card, they've got a car loan, maybe a personal loan for the bathroom renovations, or they got bought furniture and they've got a few debts out there that they're struggling to pay. Right. So the solution there is to take all those debts and secure them against the home on a new interest rate that would be similar or the same as their home loan. What that does is the monthly repayments are a lot lower. You technically have 30 years to pay that debt, and that obviously increase your borrowing capacity by quite a lot.
So refinance the family home, extend the length of the loan back to 30 years, include
not necessarily, but the debts they have would all be put together into one split for 30 years. So instead of having like 5 years to pay a car loan.
So a new split. Okay, so add it to it. Yeah, okay.
Yeah. What that does is we don't want people to pay a car loan for 30 years. That's ridiculous. But on paper, they've got 30 years to do it.
Yeah.
We reset that loan for 30 years, but maybe with extra repayments. So they would actually pay it off in 5. But the bank doesn't look at that. They look at, okay, it's for 30 years. So the monthly repayment, minimum monthly repayment are a lot lower. It gives them a break if 1 month they want to go on holidays, or it's Christmas coming, or whatever it might be. And on top of that, if they're looking to invest, that's opens up their borrowing capacity.
Okay, so it increases their serviceability because they don't have all these other finance liabilities they have to pay. And when lenders look at that, they go, I don't like to look at that. You'd like credit too much, and there's too much risk there.
And the cash flow is a lot better. Obviously, if you got a 6% rate, it's better than your 20% on the credit card.
Yeah, so the rate is like interest on credit cards like 21, 22%. Even on a car loan, depends when you got it. You might be paying 7 or 8%. Store cards, all that sort of stuff. So don't have any debt outside of your, in this case, is principal place of residence. It's going to increase your serviceability, help get your finances under control, help with your budgeting, give you some headspace and breathing space, so then you can start thinking about investing.
Cash flow. And sometimes people are going to think I'm crazy to do that, but sometimes I have refinanced people on a higher interest rate to get to a bank that could allow for this, to give them a break until they get back to normal, and then we can look at what's the next step.
So you might need to pay a bit of a premium on the interest rate.
Not necessarily, but it could happen.
Maybe, but still you're consolidating all your debts in one area, which you would argue is still... Yeah. So you might pay a little bit more on your home loan interest rate, but it's probably going to be significantly less than the debt on other stuff. What's the biggest credit card bill you've seen?
I think it was just over 100,000.
God.
Over 6 credit cards, I think it was.
So the balance was 100 grand.
Yeah.
Oof. And were they struggling with repayments?
Yeah. And we're talking here someone that has very high income, really educated, just, living the life.
Why weren't they paying it down every month? Just over. Yeah. And the base of this also is really good balance, really good budgeting. And credit cards are, you get people pro and cons around credit cards, sort of a little bit outside the scope of this, but if you're good at managing your money financially, that can be better. Like, you get points and all this sort of stuff, right? You get 55 days interest free, so it's a bit of a working capital thing. And also, if there's fraud on your card, on your credit card, the likelihood of mitigating that fraud and getting your money back is probably a lot better than if you use a debit card, right? So using someone else's money does have its advantages. However, if you can't manage it very well, it can be really detrimental. Point number 2 on the 10 hidden benefits of refinancing: access to different valuations and different level of equity.
Yeah. So when we do a refinance, or we try to get a valuation on the property to invest, let's say your property is worth around $1 million, you might have 10 to 20% variance between lenders. And obviously that makes a big difference when you want to release equity. So again, sometimes it's not about the rate. We might refinance to a lender that has the same rate or even higher, because we might get 50, 100K extra in equity to invest or to do the renovation of the home or whatever it might be that clients need the equity for.
Okay.
So that's it could be very different. We get 10 to 20% variance between lenders on the same property. Okay,
so you can shop around the valuation, really.
Yeah.
How often would you go, I don't like that valuation, let's go to another lender and get another valuation? Yeah. So it's just a big game.
Yeah, we do. We do try to get 3 valuations per property.
Do you?
Yeah.
From 3 different lenders?
Yeah.
And you'll take potentially the best valuation?
Yeah.
And it could be 10 and 20% different?
Yeah, it can be a huge difference. Yeah.
Don't they all use a similar valuation company?
Well,
it depends
if
on
they
the
do
day.
a desktop, if they send somebody in, if something just settled the day before, like it's just what data they're using. Yeah, it can be quite different.
And would you take to the client and say, look, I've got 3 valuations from 3 different lenders, and then you would actually make a decision saying, this valuation is 15% higher, however, the interest rate they're offering you is a couple of basis points higher. Means you can draw out more equity.
What's the priority?
Yeah.
Sometimes, deciding not to take that money now delays the investment purchase. Well, that can be a cost if the property is worth 50K more later.
And this is my point around how
for investors are not so important.
Yeah, and this is my earlier point around how finance is critical. It's the game of finance, you want to call it that. It's how well you can, and these are the nuances of it, where you can get differences of 10%, 15% in the valuation of a property, and therefore allow you to draw down more money. You might, on that basis, be able to buy two more investment properties as a result of leveraging that equity rather than one, or two different types of properties, or a different type of property. You might be able to upsize to something a little bit more valuable. So, okay, that's a good point. Point number 3, reduce the rate by reducing the LVR.
Yeah, so that could be also somebody that doesn't have any plan to buy anything else, but let's say they bought at 90%, they got rates that are not so sharp because it is 90%. So just redoing the valuation, if the bank realize, okay, well, now you're on 80%, you'll get better rates.
And you need to refinance for that purpose, or?
Yes and no. Some banks will allow you to do an internal refinance, basically.
Yeah, and I think I've done that sometimes where I call up the bank and say, I want a cheaper rate, and I go, no, the LVR position's too high. And then you try again in 6 months' time and the LVR position's changed, and therefore they go, you're under 80% LVR, therefore we can offer you a sharper interest rate. Yeah. But often you need to actually refinance in order to get the benefits of that.
Yeah, some banks would not, especially if you've settled, let's say, in the last 6 months, some banks won't really care about what the value is now. And we know, for example, in Perth, things have changed so much in the last 6 months.
Yeah.
It's likely if you bought something at 90%, it would be 80 now, but the banks won't let you check that. So you might have to move to get sometimes 1% cheaper between 80 and 90.
Okay, that makes sense. Point number 4, access equity to keep investing.
Yeah, so that's sort of touching on the other point is, refinancing can be just about getting equity to keep going.
And that's how most people think about refinancing, right? It's like the accelerator to, because it's hard if you're a property investor and you're generating income, and if you're relatively new to property investment, and depending on what you're buying, but good investable properties, you won't be expecting to be positively geared for a period of time. So you're going to be negatively geared. So therefore, you're going to be supplementing your portfolio with income, however you're generating that income. So during that period of time, a lot of people aren't necessarily saving huge chunks of money. So in order to be able to keep going, you need to extract the equity. Basic 101 type stuff. And I'm conscious we're just throwing around themes here, which we think is pretty straightforward, but for a lot of people, they go, what? Explain that again about how equity and release. It's so horses for courses. There's heaps of
info. Are we happy to chat to people if that's something, actually maybe I can do that? Well, let's chat.
Yeah. So if we're going through this too fast, I'm sorry. The team at Finni will be happy to have a yarn with you. Or you can just go and check out smartpropertyinvestment.com. We write about this stuff all the time. So I've got 5 other points here about the 10 hidden benefits. Are they really hidden? Or that sometimes unknown?
If you are an investor and you've got a few properties, you
probably know this.
Probably know some of it, but maybe how to access that is different. But if you're talking to the basic person that would have maybe just their home, they would have. They're
going, what are these guys even talking about? Yeah. See, a lot of people are probably going, well, that sounds dodgy. Yeah, people go, this sounds dodgy. Dodgy. This is just again the game of finance. The game of finance, if you can play the finance game really well, often the asset selection you can work out, but you've got to get your finance sorted out. Welcome back. Phil from Smart Property Investment, Eva from Finni Mortgages, finni.com.au. Now, we're running up to Christmas. You guys have capacity to chat to people who are going, I want to refinance before Christmas. Is that possible?
Yeah.
Because I know you're off on a work conference for a little while, but
just a few days.
A few days. So,
so you free next year. We'll do March.
Okay, so you got time. You got time to help people.
Yeah, we can definitely.
Okay. All right. Point number 5 on the 10 hidden benefits of refinancing. Different policies you can access. And you give me some notes here. Equity release, 100K, 1 million, 80% LVR. Income assessment stuff, buffer levels, which is an important point in different policies altogether that may work better for you.
So that's all like the nitty-gritty, but really Bank A, even if you, let's say, have a property worth 5 million and you've got 2 million worth of equity in there, some have policies that you can only get 100, and that's all it is. You can
only pull out 100K.
Yeah, otherwise you need evidence of where it's going. If you buy a property, they need a contract of sale. So different way of seeing it. Some would give you up to 1 million without asking questions. Some would be like, it's 80% or 70% LVR and that's it. So also depends what bank you're with. You might have a lot of equity but can't get it. That's one of them. The other one I've put there is buffers. So different banks assess people differently. And the one we see right now being quite different is, let's say, couple with 2 kids, some banks might say, oh, look, you spend at least 5,500 a month. Some would say you spend 7,000, regardless how much you spend. That makes a big difference in how much you can borrow.
So that's buffer levels on what they assume.
Living expense,
Yeah, okay. And some lenders will allow you to refinance if you had a loan for a while and you're a good repayer and never missed anything and everything's super clean and your trust is positively geared or whatever, without the 3% on top of your assessment.
That's right.
Yeah.
So 3%, most people these days would fail almost to refinance dollar for dollar. But having that 1% trick there, then suddenly it works.
So most people would fail dollar for dollar, do you think, from when they really?
Yeah.
Because rates have gone up so much?
Yeah.
So that's a general question, but how many people really redline their serviceability and their borrowing?
Oh, we pass by $1 sometimes.
Yeah? Do you ever sit there and just think, you probably shouldn't be investing in property?
Well, yes and no, because it's again, you assess on 9%. Or 10 almost. So there's so many buffers there.
Yeah. Okay. So I'm generalising, but so people aren't taking on too much debt when they. Or it's a risk appetite thing, right?
Like they take 70 to 80% of rent, let's say on average. Assessed at 10%. You spend 5,000 a month, they assess as if you spend 7.
Yeah, okay.
Your credit card, they would also add buffers. Add buffers to everything.
Okay. So if you actually get a
loan, you'd be fine.
Yeah. Okay. Yeah. All right. Okay. And then income assessment also is different lenders will view it differently. If you're self-employed, if you actually, they'll include your commissions. Some people won't include commissions. They'll include your bonus. Some won't include your bonus. So again, you've got to find the right policy to suit the outcome. You're never going to know this if you don't use a mortgage broker.
No, even us sometimes like, oh, okay, what is this bank doing? Like we check constantly because there's so many different ways to get someone.
Skin a cat. Is there a French version of that? Have you heard that? There's so many ways to skin a cat. What is it in French?
Chat la souris, the cat in the mouse.
Okay.
Yes.
All right. Point number 6, increase in overall capacity by targeting more flexible lenders. So you know where to go.
Yeah, so a bank would give you $1 million, another one would give you 1.5 for exactly the same income, same debt, same.
Just because they look at things differently.
Yep.
Their credit officers are different.
Not really the assessors, it's just they've got more capacity, more appetite for risks.
Okay, that's a good point. So at different points of time, different lenders will have different attitudes towards lending money.
Yeah.
And some of it could be APRA related, where they're only allowed to grow their books at a particular speed. And I don't want to get into that today, but APRA, the regulatory body, will say, you know what, we only want lenders to increase the size of their investment book, as in loans for property investors, by a certain amount. If it gets too much, they start getting jittery
and
they go to stop it.
Yeah, that's right.
So what happens then? Some lenders go, okay, we've got a fair bit of fat and capacity. We want to, using quite flippant colloquial language, we need to move a lot of mortgages. So therefore, let's introduce some interesting policies to actually be more attractive. So therefore, we will get more loans through the door. Whereas other lenders will go, we've got to slow down a little bit. Let's just make it a little bit harder and do this. And they'll tell brokers about it. And then so essentially brokers will stop recommending them loans because they can just put up their rates by 0.5%, and then everyone goes, well, they're too expensive, let's not send them any business. And the bank goes, okay, job done, no worries. They'll sit in the side for a while, let things wash through, and they'll be back.
Yeah.
Okay.
That's exactly what
they play the game as well.
Yeah, that's right.
They play the game as well. And I will note also is that we have a pretty robust and rigorous banking and regulatory system here in Australia. One of the reasons why we typically do well when stuff like the global financial crisis happens and COVID and all this sort of stuff. So the banks and lenders who are ADI orientated, approved deposit taking institutions, they've got to play by the rules, and the prudential regulators pretty tight on making sure that they play by the rules, and there's fines and stuff. So because of that, structurally, there's a lot of providence and there's a lot of integrity in our banking system. So when banks move and change and shape their policies, they're doing it within the rules. Point number 7, resetting the term to 30 years to increase capacity and lower repayments. That's not a bad idea.
Yeah,
a lot of financial planners will say, don't do that, but you know.
And again, when we reset loans to 30 years, doesn't mean you have to take the 30 years to repay the loan, right? It's just on paper, well, it looks like it's more manageable. It looks like your repayments are lower. Your minimum repayments are actually lower, so you can borrow more money. Nothing stops people from making the same repayment that they used to, or extra repayments, or actually paying down their debts.
And that's quicker. A really smart strategy, right, to do it, because then you just put it in a redraw facility, or you can offset it.
Yeah.
Again, that's getting super tactical. You can pick that up at another time. But I know people who have done that. It can alleviate some pressure if mortgage rates are too high, and or increase your serviceability so you can secure more debt. Yeah. Point number 8, resetting interest-only period for cash flow.
Yeah, so that's really the investors we're working with here. So often they have 5 years interest only, and a lot of them came out of that last year, and it will happening this year, next year. Obviously, with the rates having gone up so much, it would be a big hit when they go to P&I.
Yeah.
So we can also refinance just for that purpose of resetting the interest only for 5 years.
Yeah, and that's not a bad time sometimes to refinance the debt to another lender, because back in the day, and I can remember this, when your 5-year interest-only period come off, you just call up the bank and say, I want to go another 5 years. They don't do that anymore. No. They've got to completely – so you instantly go to P&I, and you've got to make sure, you've got to be really careful also, and your broker should be across this, is that when you actually sign the loan documents, you've got to have a look at what the rate resets to when it moves to P&I. And I know a lot of people get stuck with that, and you've got to haggle hard, or you've got to use that as a catalyst to refinance, because you end up paying a premium on the P&I rate, right? These things happen. So, you need to try and get that factored in the front. And you might think, it's 5 years away, don't worry about it, we'll sort of that then. Fair enough, but you got to be right across it. It is a hassle, though, having to redo a full loan thing. It's whether that'll change back the other way. I don't know why it went that way. Maybe it was a APRA requirement that they had to, you couldn't just say.
Yeah, because the thing is, let's say it was 30 years, they had their 5 years interest only. Now it's 25 years to go to pay the loan.
Yeah.
And then if you reset for 5 years again, that's only 20 years to pay the loan. And for most people, once that would hit P&I with 20 years to go, they can't make the repayment.
Yeah. And
that's why people are declined these days.
So this is the point. You sign a 30-year loan, a 30-year loan term. The idea and the principle of that is that you that loan is paid off in 30 years. So essentially, you're just saying, for 5 years, I don't want to pay any of the principal. So you just keep pushing the can down the road.
And then it's harder and harder.
And it gets harder and harder and harder. So therefore, structurally, you may need to refinance. And a lot of property investors just go from 5 year term to 5 year, and they never ever pay off the principal, right?
Yeah, and that's a fun strategy too. Is just they have to be aware that after 5 years, they need to do
at
something.
some point in time. Yeah. So paying P&I from the front end means that it's going to be spread out for a more longer period of time. Anyways, it gets really quite tactical. Point number 9, get expert advice on structure of your loan and products you need for each. So principal residence, investment cash, SMSFs again. So structure is key, right? Different lending and different structures.
That's what we do a lot with I guess, mom and dad having 1 to 2 properties. They've set it up themselves, or they went to their bank, and it's not very clear what's tax deductible, what's not. It's cross-collateralized. All the mistakes we see all the time. So talking to us for a refinance is also a good opportunity to get, okay, well, look, it's not done properly. Let's fix it up and start from scratch again. So that's...
Do you spend a lot of time fixing bad structures?
Yeah.
Is that a lot, like most of the time, is fixing that? Yeah, really.
Yeah. And crossing, making sure what's tax deductible is in a different split. And
why do people, so people who cross-collateralise typically went directly to a bank?
Yeah, in bank, or they don't even know about the fact that it is crossed.
Even though they signed all the documents and they never really got explained. Yeah. And is that if they went direct to the...
brokers as well, because it would be a lot easier and quicker for us to cross.
Yeah, and this is why you need to make sure. I Googled Finni the other day on Google, and I Googled what did I Google? Property investment finance, and it comes up number 1 for Google for property investment finance. And I was like, oh wow, I knew you guys are pretty good, but this is the point now. If you want to be, specialising in, I know you do a lot of principal place of residence stuff, and that's cool, and you should be doing that, but if you want to build a property investment portfolio, you need to be working in lockstep with a mortgage broker that actually understands property investment, is the point that I'm making. Because if you go down a pathway with maybe a broker who doesn't specialise in this and they're quite comfortable around owner-occupied stuff but don't normally do principal do investment stuff, when they start cross-collateralising your first investment property against your principal place of residence, you're just accelerating a bad structure that if you do it it gets harder to unravel.
With the new trust fave at the moment, we're starting to see trust lending being crossed against the home.
Is that possible? So they'll cross a loan inside of a trust into a principal as resident outside of the trust. I didn't know you could do that.
Well, me either until I.
Are brokers doing that, or is that coming out of it?
Yeah, he was a broker, and fair enough. At some stage, the broker of that person said, "Look, I'm not really comfortable with all those investment stuff." So that's how we got declined. But it's getting pretty. Yeah.
I'll tell you, it's and again, I was chatting about this with my accountant the other day. It's really hard when you start off investing. You don't necessarily know where it's going to end up. So the structure for you today probably necessarily might not be the best structure for you in 10, 20 and 30 and 40 and potentially 50 years' time as a property investor, right? But it's hard to think, wow, in 50 years' time, what structure am I going to need in order to suit the benefits of what I have then?
Because we don't mess up what's done today.
Yeah.
So whatever it is that we have done doesn't mess up what you will do. I think that's the minimum required.
Yeah. It's mate, just work for a broker. Work with a broker that actually knows property investment. And last one here, and you see this every now and then. I spoke about how, lenders, have different varying appetites at different time for mortgage finance. And I think they're coming back in cashbacks. So when you start seeing cashbacks, you pretty much know that lender wants a lot of business.
There's one left for refinance, one left for ONOC and that. But watch the space. I know they're coming back.
Okay, heard it here first.
Money throwing for getting new loans would be.
And is it worthwhile changing loans for a cashback?
No, but if it's there, why not taking it?
Yeah. Okay. So it's just. So do you actually does the cash come off the balance of the loan?
No, it's literally cash in your account.
And how much will they give? Like $5,000?
It used to be 1, 2, 3, 4 at some stage. Yeah.
And the idea is that you go and spend it. So that's inflationary. You talk about power bills being inflationary. People with $4,000 to spend.
Yeah.
And do you find people just keep refinancing to keep getting their cash back?
Yeah, there's been a bit of that, which also I think was the reason why
they stopped doing it.
They stopped doing it, but then they also put if you refinance, you'll get your money, but you have to stay with us for 6 months or for 2 years or whatever it was.
Okay. Sounds like all right. Most investors don't get, I don't want to say fooled, but they don't get obsessed with this idea of cashbacks. The interest rate, it's about getting the debt, even if it's a slight premium. It's about the speed and the utility of the debt rather than, wow, if I refinance, I get $4,000 in cash, right? You know.
But look, if it's an investor with 5, 6 properties and it's $4,000 per property.
Well, there you go.
Well, you can buy another property.
Wow. So people doing that to raise deposit.
I've done that.
Have you seen it?
Yeah, I've done that.
No. So all with the same lender?
Yeah.
So refinance.
Some used to do per property.
I've never even thought about that before. So I can refinance 10 loans with a lender.
It was per property.
And I get $4,000 for $40,000.
Yeah.
And then use that as a deposit for another property.
Yeah.
With a different bank.
Yeah.
God. Really?
Well,
have people got that much time to think about this?
No, to be honest, this one was it actually happened to be that way. That was the best lender for that person.
Yeah.
And it happened to be that way. So it was like.
And did they go, cool?
Yeah. Cool.
What do they do with the money?
I actually don't know.
It's like a second job.
Yeah, definitely a good one.
Yeah. Okay.
Look, that's probably coming back. And look, again, it's not the reason why you would move, but if the banks are giving you a bit of money for it, why not? It pays at least for the cost of moving, which can be,
So your active property investors are probably always thinking about refinance because they're thinking about what next and resetting their loans to the right point in time. But there'll be there'll be structurally reasons why that you need to refinance, and I think we're looking down the barrel of it. When interest rates start coming off, you'll start seeing a spike in refinancing, because there's always a lag between lenders passing on that, if they pass it on at all, and there's also a lag between people getting around to actually going, oh, hang on a second, maybe I'm overpaying on my mortgage, so I reckon it's going to be heady times for refinancing at the back end of next year, but get all your stuff sorted out now, which means getting all your tax returns sorted out. It means if you're self-employed, having all your BASs and everything up to date and paid and current, that you're actually working with your accountant to ensure that your finances put you in the best position to secure finance. You got to start working on this now. Good. You're happy to talk to people about this?
Yeah, look, we've set up a new easy way for people to get in touch with us. We've got a Calendly link now on our website.
High tech.
They can just get in, book it in.
So you can choose a time.
Yep.
So you can just go in there and like, I want this time, and it automatically happens.
Yeah, so it would be a lot easier.
Who do they get to speak to? Just
anyone.
Yeah. All the brokers that you have.
Yeah.
They're all good. All right. Thanks, Eva.
Thank you.
And where do they do that? Finni.com. FINNI.com.au. That's Eva Loisance, the head broker at Finni. Get in touch with the guys. It's not too late as you get ready for Chrissy, and even get yourself sorted out, because there's some good buying over the Chrissy period. That's what I found personally. A lot of people aren't out buying properties then, so sometimes you can really land a good bargain. Thanks for tuning in. Remember to check out smartpropertyinvestment.com.au, social media, Smart Property HQ or Smart Property Investment. You'll track us down. Please keep those reviews coming wherever you're tuning in to this podcast. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.